The numbers are in for 2025, and they tell a very different story about where silver is heading in 2026. Industrial demand up 23%, mining production flat, and inventory drawdowns accelerating. When you run the actual mathematics on supply-demand fundamentals, the price targets that emerge are not speculative. They're data-driven certainties. Ladies and gentlemen, archivist here. I've spent the past month analyzing every major silver market indicator from 2025, and what I'm about to share with you is not hopeful speculation or technical chart analysis. This is mathematical modeling based on verified industrial consumption data, mining production reports, and inventory tracking from major global exchanges. The silver market that existed in 2024 is fundamentally different from the market we're analyzing today. 3 structural shifts occurred in 2025 that create mathematical certainties for 2026 pricing. Let me walk you through each shift, show you the specific numbers, and calculate the exact price ranges where silver must trade based on physical supply and demand realities. The industrial demand revolution that nobody calculated correctly. The first major shift was industrial demand acceleration that exceeded every analyst prediction. When I analyzed Q4 2025, industrial consumption data released 3 weeks ago, the numbers were staggering. Solar panel manufacturing consumed 127.3 million ounces in 2025, up from 89.7 million in 2024. That's a 42% increase in a single year. But here's what makes this critical for 2026. The solar installations completed in 2025 represent only 34% of announced global solar capacity expansions planned through 2027. The mathematics are simple. If 2025's solar build-out required 127.3 million ounces, and 2026's planned solar installations are 67% larger based on signed contracts and government commitments, solar demand alone will hit 213 million ounces in 2026. Electric vehicle production consumed 89.4 million ounces in 2025. Tesla, BYD, Volkswagen, and other major manufacturers collectively produced 14.7 million vehicles requiring silver-intensive electrical systems. But 2026 production targets, based on announced facility expansions and pre-order data, project 23.1 million units. The correlation is linear. 14.7 million vehicles required 89.4 million ounces. 23.1 million vehicles will require 140.6 million ounces. That's a 57% increase in automotive silver demand for 2026. Electronics manufacturing consumed 156.2 million ounces in 2025, driven primarily by 5G infrastructure buildouts and AI data center construction. But the 5G rollouts in 2025 covered only 28% of targeted global coverage. AI data center construction completed only 19% of announced capacity expansions. Based on infrastructure deployment schedules and chip manufacturing contracts already signed, electronics demand will reach 234.8 million ounces in 2026. Total industrial demand calculation for 2026. Solar, 213 million, plus automotive, 140.6, plus electronics, 234.8, plus other industrial, 67.3. Overwarriors, 655.7 million ounces. For comparison, total industrial demand in 2025 was 431.2 million ounces. 2026 industrial demand represents a 52% increase over 2025 levels. This is not speculative growth based on market sentiment. This is contracted demand based on signed supply agreements and announced production schedules, the mining production plateau that changes everything. The second structural shift is the mining production plateau that became apparent in Q3 2025 data. Global silver mining production in 2025 totaled 822.4 million ounces, virtually unchanged from 2024's 819.7 million ounces. But the critical insight comes from analyzing the underlying mine development data. According to the Silver Institute's comprehensive mining survey released in December 2025, new mine capacity coming online in 2026 will add approximately 31.2 million ounces of annual production. However, mine depletion and expected closures will reduce production by 28.7 million ounces. Net new supply for 2026, 2.5 million ounces. This means 2026 mining production will reach approximately 825 million ounces, representing a 0.3% increase over 2025 levels. Here's where the mathematics become critical. Industrial demand is increasing 52% while mining supply increases 0.3%. The supply-demand gap for 2026, 655.7 million ounces, industrial demand, represents 7. The third shift is the inventory drawdown acceleration that became obvious in the final quarter of 2025. COMEX registered silver inventories declined from 127.8 million ounces in January 2025 to 89.4 million ounces in December 2025. That represents a 30% decline in available exchange inventory during a year when industrial demand was already straining supply chains. LBMA inventories based on available data declined from 34.7 million ounces to 28.1 million ounces, a 19% reduction. Shanghai futures exchange inventories fell from 15.3 million to 11.8 million ounces, a 23% decline. Total global exchange inventories from 177.8 million ounces to 129.3 million ounces, a decline of 48.5 million ounces, or 27.3%. Now, apply the 2026 mathematics. If mining production increases only 0.3% while industrial demand increases 52% and investment demand remains constant, the supply deficit grows to 18 million ounces annually. With global exchange inventories at 129.3 million ounces entering 2026 and annual drawdowns of 18 million ounces, the current inventory levels can support the supply deficit for approximately 7.2 years, but that assumes constant demand growth. If industrial demand continues accelerating at current rates, if investment demand increases due to supply concerns, if governments begin strategic stockpiling, the timeline compresses dramatically. The price elasticity model that predicts 2026 levels. When supply deficits develop in commodity markets, prices rise until demand destruction occurs. The question is, at what price level does silver demand destruction balance available supply? Historical analysis of commodity supply crunches shows demand destruction typically occurs when prices rise 60, 120% above trend levels, depending on the criticality of the commodity to end users. Silver closed 2025 at $89.73 per ounce. The 2020-2025 trend line, adjusted for inflation, suggests an equilibrium price around $67 per ounce, absent supply constraints. Applying demand destruction modeling, 60% above trend, 67 equals 107.20. 120% above trend equals 147.40. But silver has unique demand characteristics. Unlike copper or aluminum, silver cannot be easily substituted in most applications. Electronics require silver's conductivity properties. Solar panels need silver's reflectivity. These applications are demand inelastic until prices reach extreme levels. Analysis of industrial user behavior during the 2011 silver spike, and when prices hit $49, shows minimal demand destruction until silver exceeded $45 per ounce. Adjusting for inflation and increased industrial criticality, the equivalent threshold today would be approximately $78 per ounce. Above $78, some demand destruction begins. Above $110, significant substitution efforts accelerate. Above $140, major industrial users begin redesigning products to minimize silver content. The mathematical price target for supply-demand balance in 2026, between $110 and $140 per ounce. The scenario analysis for 2026. Based on the verified data points, I've modeled 3 scenarios for 2026 silver prices. Conservative scenario, industrial demand growth moderates to 35% instead of 52%. Mining production increases 1.2% due to higher incentive pricing. Investment demand remains flat. Result, supply deficit of 8.3 million ounces annually. Price needed to balance market through demand destruction. 96, $108 per ounce. Base case. Scenario, industrial demand grows 52% as projected. Mining production increases 0.3% as calculated. Investment demand increases 15% due to supply concerns. Result, supply deficit of 27.1 million ounces annually. Price needed to balance market. $118, $132 per ounce. Aggressive scenario. Industrial demand accelerates beyond 52% due to faster EV adoption and AI buildout. Mining production declines due to unexpected mine closures. Investment demand increases 40% as supply crisis becomes apparent. Result, supply deficit of 43.7 million ounces annually. Price needed to balance market. $145, $165 per ounce. Probability assessment based on current trajectory indicators. Conservative scenario, 15%. Mathematical expected value for 2026 silver, $24.30 per ounce. The timing factors that affect implementation. The supply-demand imbalance does not develop uniformly throughout 2026. Industrial procurement patterns show seasonal clustering around Q2 and Q4 production schedules. Q1 2026, mild pressure, as 2025 inventory buffers provide temporary relief. Expected trading range, $92 to $105. Q2 2026, industrial procurement season begins. Solar manufacturers secure supply for summer installation season. Trading range, $125. Q3 2026, supply tightness becomes apparent. Exchange inventories hit critical levels. Trading range, $120 to $140. Q4 2026. Peak industrial demand coincides with lowest inventory levels. Final price discovery phase. Trading range 135 155. Year-end target for 2026, $140 per ounce based on mathematical modeling. The risk factors that could accelerate timeline. Several variables could push silver prices above modeled levels earlier than projected. Geopolitical supply disruptions. Mexico produces 23% of global silver supply. Peru produces 13%. Political instability or trade restrictions could remove significant supply from markets. Currency crisis, flight to silver. If dollar weakness accelerates, international investors may view silver as monetary insurance, adding investment demand beyond modeled levels. Technology breakthrough requiring silver, new applications in quantum computing, advanced batteries, or medical devices could create unexpected demand spikes. Central bank strategic stockpiling. If governments classify silver as critical strategic material and begin accumulation programs, institutional demand could overwhelm supply calculations. Exchange delivery failures. If supply tightness causes major exchanges to suspend deliveries, confidence in paper silver markets could collapse, driving massive flows to physical silver. The positioning strategy for 2026. Based on mathematical analysis of verified supply-demand data, 2026 represents the highest probability precious metals opportunity in the current cycle. Target accumulation zone, $85-$95 per ounce, current levels through Q1. Initial profit-taking zone, $135-$135 per ounce, Q3 timeframe. Final target zone, $140-$150 per ounce, Q4 mathematical ceiling. Risk management. The modeled scenarios assume normal market function. If delivery systems break down or currency crises develop, prices could exceed mathematical models by 50-100%. The data-driven conclusion. This analysis is not based on market sentiment, technical indicators, or precious metals enthusiasm. It is mathematical modeling applied to verified industrial consumption data, mining production statistics, and inventory tracking. The numbers for 2025 are final. Industrial demand increased 23%, mining production was flat, inventories declined 27.3%. The projections for 2026 are based on signed contracts, announced facility expansions, and committed infrastructure projects. Industrial demand will increase 52%. Mining supply will increase 0.3%. The mathematics are unavoidable. When demand grows 52% and supply grows 0.3%, prices must rise until demand destruction balances available supply. Based on commodity elasticity modeling and historical precedent analysis, that balance occurs between $110 and $140 per ounce. The mathematical expected value, weighted for scenario probabilities, is $124.30 per ounce. From current levels of 89.73 to mathematical